The historian and documentary maker Ken Burns called the Great Depression the second greatest catastrophe to befall the USA after the American Civil War. These two events are interesting markers, partly because the last of the generation that fought in the Civil War as very young men saw the Depression as octogenarians, and because the men who caused the crisis and those that took steps to remedy it were born and grew up during the war. Two men, Carter Glass and Henry Steagall, barely school age when the battles of Bull Run, Vicksburg, and Antietam were being fought, would grow up in the grinding poverty of the post-war Reconstruction era in the South, and brought about during their morally checkered careers one of the greatest innovations in 20th century finance, the Glass-Steagall Act, separating retail banking from securities trading, preventing Wall Street from playing fast and loose with the savings of Middle America. Neither of these men were progressives, it must be emphasized before we decide to view them in an overtly sympathetic light. Carter Glass, whilst the member of the state Senate for Virginia, voted for a literacy test with the explicit intention of disenfranchising black voters, and Henry Steagall from Alabama was known in quasi-feudal terms by Alabama blacks as Massa Henry. It seems in conventional thinking somewhat odd that two Southern reactionaries were architects of a policy that kept rapacious finance at bay for well over half a century. The answer to this conundrum once again lies back in the American Civil War era. By the 1850s, America had become two separate countries, North and South, and some might argue that it continued that way. It can be argued that two different countries existed because Northerners and Southerners had two fundamentally different cultures, outlooks, and sets of values. The plantation-based South was rural, feudal, unchanging, but with a booming world demand for cotton, wealthy enough to ignore its dynamic northern neighbour. In the North, the slavery of the South was not only morally distasteful, as the popularity of the book Uncle Tom's Cabin in the 1850s showed, but it was also an anathema to the new rising industrial and financial middle classes who relied on free, cheap, sweatshop labour from Europe. To a Southerner, a banker represented all that had become corrupted and weasel-like in the Yankee North. And this was not just a grassroots opinion. Carolina-born President Andrew Jackson argued that a federal central bank was little more than a conspiracy against ordinary men, and would only accumulate wealth in a tiny number of hands. Hardly what had been intended by the Founding Fathers. And with remarkable prescience, he predicted that banks would be controlled by only a handful of families, or now read corporations, and even worse, the North would benefit from this accumulation of capital at the expense of the South. So there was a rich tradition in the South of anti-finance populism, a world away from the far more left-leaning Occupy movement of today, and yet in many ways strikingly similar. Whilst less well articulated, there was still a widespread and deep-seated mistrust of Wall Street finance, and this mistrust was given credence by both North and South in October 1929. It's too simplistic to claim that banking malpractice and the fusing of retail and investment banks alone was responsible for the Wall Street crash, but it's not an insignificant factor either. The story of the 1920s actually reads very much like our own narrative from the mid-90s to the late noughties. An economy built on shaky foundations, depressed agricultural prices, high levels of consumer debt, a culture that was willfully oblivious to the future, and a financial sector let off the leash, all these built up to the crash of '29. 3 years of nightmarish economic hardship in America, followed by a further 6 years given Roosevelt's refusal to abandon the gold standard and allow a devaluation, led to the Democrats taking power in a landslide. And their first task within hours of office was to commence banking reform, literally days before a final collapse of the banking system. How had an unchecked financial system brought America to its knees in a way that General Lee and Stonewall Jackson had failed to achieve? By using the financial system, paper money, and the toxic derivative of the day, corporate securities or insecurities, against the people. By the end of the 1920s, as the economy, laden with consumer debt, began to grind to a halt, a new way to sell shares to a cautious public was born, lending unwary speculators the money to buy shares. Knowledge of the stock market in small town and small investor America was limited to the idea that it was simply an extension of the omnipresent meta-narrative of the American dream, a mystical money-making machine that, in the words of John J. Raskob, meant that everyone could be rich. Put the bank's money in, so the logic went, and wait for the shares you have bought to double in value and walk away with pure profit. It's hard to think that such naivety existed, but it's not so different from the various utopias that we've all been sold in the past decade or so. The money that financed this margin selling came, of course, from retail banking. And not only did high street deposits pay for such reckless speculation by individuals, but when the likes of JP Morgan or Chase National Bank wanted to buy shares, they did it with other people's money as well. As with any business that operates at a supranational, supra-legal level, profits are privatised and costs and risks are socialised to the rest of us, and in 1929 and 2008 this was true. After panicked investors saw their life savings vanish in a flash of ticker tape, panicked savers realised that their deposits were all gone, and hundreds of small banks began to collapse one after another as a stampede to withdraw whatever could be clawed back and stuffed under the mattress began. The Glass-Steagall Act was really just 4 provisions drafted by the two men in the 1933 Emergency Banking Act. But there's strong evidence to suggest that these 4 provisions stabilised the US economy, and therefore the global economy, throughout the post-war era. That was until, of course, they were repealed by another Southern gent, President Bill Clinton. After 60 years of relative stability and the longest sustained period of economic growth in human history, one of the key safeguards between people and finance was abolished in 1999. The threat that grew from 1999 to 2008 was slightly different from that which existed the first time round, however. Casino investment firms did not need the guarantee of individual savings deposits to underwrite them. They knew they had government and taxpayer dollars to fall back on. Now, instead of securities traders selling Ponzi scheme products to unwary investors, retail bankers were allowed to do exactly the same and had far greater scope to con far more people. Instead of the stock market as the source of unlimited magic wealth, America and the world were sold derivatives based on fictitious property values. The one similarity that the two frauds and the two crashes share, however, is the scant absence of prosecutions. So, what can we draw from all this? Even when 2 arch reactionaries from the Deep South muzzled Wall Street, it took only one freewheeling, sax-playing, supposed liberal from Arkansas to set it free again, and there have been no new Glass-Steagalls since 2008. Well, the obvious answer would be to walk away from banks altogether, though that's easier said than done. Banks need money to keep going, and money, as I will explore in later posts, isn't real. It's a fiction we all choose to believe in, rather like the fairies in Peter Pan. Every time you say you don't believe in money, somewhere, somehow, $1 or €1 dies. Instead, it makes sense to invest in real-world, tangible assets. If you'd like to find out more about this, check out our website. Thanks very much for listening.